We're here very briefly to talk about the commission disclosure issues that we've been experiencing. Fortunately, that's not a Moorgate Broker Network thing. This is a global thing. And talk about a little bit about how, from a sales perspective, you can mitigate any concerns that customers have with regards to disclosing commissions. Since yesterday, there's been a lot of progress in terms of how the industry, how we're dealing with this. Firstly, it is a unmitigated fact from yesterday onwards. We are all going to have to disclose the amount of commission we earn on a deal. There are a few loan funders and a handful of, and I mean 2 or 3 asset finance lenders who are yet to disclose, to declare their position on the whole thing, but you are going to be having to disclose commission, basically, if you want to give a decent level of service. There'll be subprime lenders out there who won't. Surprisingly, Liberty have already come out and said that they are, but obviously every lender is going to be nuanced. Liberty, for example, it's going to be a piece of paper that's put in front of the customer's nose at the point of sign up. So that's how they're getting on with it. In terms of where we are right now, almost every lender, bar Aldermore and Close, is back open and paying out deals as we speak with the use of a disclosure document. The main exception to that is DLL at the moment, who I've just spoken to Vic Wixie, our BDM, and he is literally sending out our disclosure documents to us case by case as we speak now. He's having to manually work out the commission due and all that kind of jazz, and he's sending them out as we speak. So we are back paying out deals, which, given the gravitas of the turmoil that the industry's experienced, is quite impressive, I think. 2.5 days in. So you are going to have to disclose.
With DLL, with the docs, if docs are already signed, how are they doing that?
If docs are already signed with any lender, they are being held at payout as we speak, and the disclosure document is going to go out by DocuSign and have to be signed retrospectively. So they're going to get it, and it will pay out. We have had, yeah.
Sorry, I had a question here. I talked to a funder yesterday, and they said they couldn't even answer their own question. What happens if the docs are in and the customer doesn't sign the disclosure, refuses to sign?
I don't think they'll know the answer yet. My answer, and you guys are obviously all self-employed. You are master of your own destiny. It is your choice, but my decision here under the Moorgate Direct brand is that we do not concede. The second we concede to a customer and say, all right, I'll reduce my fee from X to Y, they know it's negotiable. And I think that's a dangerous precedent to set if you've ever got any intention of monetising that relationship moving forward. I just don't think you can concede. I'm not allowing the internal guys to concede at all. I think stage 1 is declare that we earn money. Stage 2 is justify what money you earn. Stage 3 is re-justify. There is no stage at which you walk or you negotiate. I just think it's really, really dangerous. My guys internally are being told to walk away from deals rather than concede on commission.
Some customers are great, others they like your advice, but as soon as they find out they're not paying for it, they find a way to try and reduce the cost by not paying for it.
Yeah, I sent an email. Alaka Bank, one of the only people who had amended the process from the norm being it's just an extra letter that goes out with the normal document pack. The customer does or doesn't read it, signs everything, sends it back. Alaka were the only people head above the parapet bar Interbay basically Interbay wanted an email direct from the customer copying Interbay confirming they were aware of the amount of commission, which was just clunky. Alica, however, when we sent in the docs to request the e-doc parcel package to go out, they would first generate a e-document that was our disclosure document, go to the customer. Customer had to declare they were happy with our commission. That came back signed, which triggered the actual documents to them. I strongly objected to that with Brandon, and I doubt it was just my moanings, but they have now come back in line with the rest of the industry. So they are as well now just sending out the disclosure document with the rest of the documents. And I think you'll agree that's largely going to be fine.
The wordings are okay.
The wording's also sensible.
The wordings says that our commission is basically comes from the interest payable, which is how you want it. So
fine. So Dan's in the room. He's just saying that their wording's actually quite kind on us. So it says that our fee comes from the interest payable on the agreement and doesn't directly doesn't inflate the cost of the agreement. So that's quite gentle wording. Arkle's wording at the moment says something along the lines of it's not our fault. It says that ARC will control the amount of commission paid. Yeah, ARC will control the amount of commission paid. Therefore, there's nothing the broker can do about it, even if you ask. But everyone's got a different letter. I'll just structure the rest of this conversation in the way that I did with my guys yesterday, which is long term, June next year, I expect every commission disclosure to be mandated, but be buried within the T's of a finance agreement. By about Christmas this year, maybe beginning of December, I expect all lenders to be using some form of uniformed commission disclosure, i.e. the letter will be similar, it will be sent out with the document pack. Right now it's a bugger's muddle. All the wording is different, the process is slightly changed, but you've kind of got to, while it's embarrassing the whole industry's been caught short, you've kind of got to take your hats off to this many banks getting in line this quickly to get disclosure documents out to us. So that's where we are right now. The main thing, as I said, is justifying your position. So I'm going to teach some of you guys to suck eggs now. That's absolutely fine if you log off, leave me to it. But I'm going to go through the training session I went through with my sales guys yesterday. Skip over the basic bits of it. I'm looking up at a whiteboard up there, by the way, not gazing into someone's eyes. Basically, we as Moorgate and you as MBN, I think, have a problem where we run around like blue-ass flies trying to get our customers a really, really good deal. And the following happens. The customer's on the phone, tells us about this, sends over, we do the info request, sends us all the info, we send a follow-up info request, we get that. And we generally kick the deal into shape. We might have a set of bank statements that are a bit lousy, we might have some really strong MI and some bang average accounts, and we will choose which piece of information we promote to the lenders, which ones, or choose lenders that aren't in that in that case interested in bank statements, and we will gild and we will flesh out a proposal to give it the best chance of getting accepted by the best lender. We do a lot of work, there's a lot of back and forth, there's a lot of BDM negotiation, and then what we do, you guys do, our internal guys do, is we ring the customer and go, good news, it's all done. And the customer has no idea about the blue-ass flyness and all the running around we've done. They've just waited 48 hours and we've gone, good news, it's all done. What I'm teaching people internally is to take our customers on the journey. So feeding back on, can't use Alica because your bank statements are weak, can't use DLL because your MI is weak, can't use Lender X because you're buying a second-hand unit and it doesn't fit age policy. So really just taking your customers on this journey of rate adjustment. So by the time they get to your commission disclosure, which you are going to have to give, you are justifying it. And the ideal scenario, and on my whiteboard up there, I've got a table that says Lender A, Lender B, Lender C. and we can furnish you with this information. Lender A might be Lloyds, can't do it because the asset's too old, you're loss making, and you've got weak bank statements. Liberty Leasing want a 20% deposit, a DG and a chatter's mortgage on other kit, and Haydock Finance. Lloyds is irrelevant, Liberty's bloody expensive, Haydock Finance versus Liberty saves them £15,000. The fact you're earning £5,000 for saving them £15,000, I really think you should all be able to speak to your customers about positively. And those are the kinds of conversations we're having. So it's a much, much deeper sell. It's a much, much longer sales process. But where it plays into an MBN method of broking versus a lot of our competition is that we have all of these other products to sell. So by going that deep dive and talking to the customer about where the weak points in their businesses, the opportunities to cross-sell and upsell are plentiful. Loans, invoice finance, VAT funding, corporation tax funding, insurance premium funding, all of these things I'm hoping are going to be spin-offs of these deeper dive conversations that we'll inevitably now be having. And other things along the way, and we can put documents together if you want, or you can make notes of this. The guys in front of me are making notes that they'll circulate to you shortly, are what we bring. So Alaka, for example, are one of they certainly sit in the front and centre of our core panel of lenders. We have a 75 points discount versus other brokerages or standard rate chart. I've got no doubt that other people have similar discounts, but versus their standard rate card, we have a 75 point difference. Now, on £100,000 over a 5-year period, that makes a huge difference to a total repay. So that 0.75 discount alone should justify most of your commission. In addition to that, we drive advantageous early settlement clauses. So Alaka, Cambridge and Counties, other lenders by request will work on early settlement rules, things like the rule of 78 versus fairly unattractive early settlement rules within the rest of the industry. We, as the network, will do any after sales, so DD management, early settlement requests, novation requests, end of term, passing title requests. We manage all of that. We've spent 10 years building our lending panel, so things like the 0.75 discount with Alaka, things like knowing which lenders will do early settlement, which lenders won't, things like knowing which lenders will pay supplier X and which ones won't, knowing which lenders will lend on older equipment and not require a DG. All of these things we've built up over a period of 10 years, and we fold into every decision we make in terms of lender placement. In addition to that, we exist in the place of bank sales team. So where, just use a different lender, Investex hard asset rates are currently at 7, about a 7 yield. If they were having to pay their own internal sales team, i.e. you and I, but employed by Investec as opposed to self-employed or partnered, they wouldn't be able to afford to go out at those rates. As simple as that. They would just have to be up at an 8, an 8.5, at which point our commission is justified. It is unjustified in my opinion that it is declared, but it is declared now moving forward. So we are not an additional cost is the point of that point. We are a cost that would be there, it's just going down a different column on a spreadsheet. The other thing obviously to note is whatever your commission is not profit. Out of that, you guys have got to eat, we've got to eat, someone's got to raise the documents, someone's got to pay the documents out, you've got to market, We've all got to do our compliance returns. So all of those things I've just gone through, I think, should give you enough ammunition as salespeople to justify these fees. But you can't get away from them, I'm afraid. There's nothing we can do. That's not true. Funding Circle have held position. They're not making us declare fees. Other short-term lenders won't. But to be fair, Funding Circle declare this fee anyway, so they've been doing it for years. It's still a very, very moving picture. The main issue that I'm fighting with the lenders about on all of our behalves at the moment, guys, is how they behave in a first come, first serve or sole mandate scenario. They have not yet had time prioritised our looking after us with that regard. They've spent the last 48 hours protecting their own balance sheets and trying to make sure they don't get sued any more than they're already going to. But I think it's fair to say the big issue here is that anyone on this call puts a deal in to any lender, discloses to the customer that they're earning £4,000, and the customer rings up the broker up the road and says, it's Alica, their acceptance number is this, can you do it for 3? Now, no one has yet come out and declared what their position on this is, but I think it's fairly obvious that they all really need to tighten up their process and communicate their process when it comes to dual acceptances. And this is something that I am absolutely ready to go to war on with a number of lenders. I've had some very direct conversations with Brandon at Alica on this morning. I will when Omar from Shawbrook calls me back. This is the crux of it. I've got no issue with disclosing our commission. I think we all do a good enough job with a good enough lending panel to justify the vast majority of commissions that we make. But I will not tolerate lenders that allow a customer to piggyback on any one of our hard work and just go and save a couple of quid by using their mate up the road. It's not fair on us, and that's what the industry's got to clamp down on very quickly. I've had a call with Norman Chambers at the MACFB yesterday at about 5 o'clock. He hadn't even thought about it, which was great. But I'm trying to rally anyone I can. We're speaking to the Asset Finance Connect, the Guild of Finance Professionals, and anyone who will listen about trying to very, very rapidly get the lenders round the table to establish a common practice for this, because I don't know about the rest of you, and I will welcome your comments on the matter, but that to me is the big worry. It's not declaring how much commission we earn, it's the fact that we can declare it and someone else can use it against us.
Yeah, I've got a deal in at the moment with Investec so I know the supplier told me it's going to 4 different brokers.
Yeah.
And I've got an acceptance, but it's coming up as one of those multiple acceptances. Now I've got a fair amount of commission, 5% commission in that, and I was well over what the target rates I was given. I was to start one of those other brokers going in with a lower commission fee, and therefore they went in business.
Well, historically, and as of today, absolutely nothing. The difference is, well, the answer is a sole mandate letter. Investec actually operate a first come, first served basis. You don't need a sole mandate letter, you just need to get back to them with signed docs as soon as possible. But in a scenario as we are today, where you're having to declare commission, it's just an invitation to your customer to try and drive your margin out of the deal for their benefit, which is kind of fair enough. If you we're all in business to drive revenue and reduce costs. You kind of can't blame, especially if you haven't got a long-term relationship with that punter, you kind of can't blame them for those behaviours. But at the same time, Investec in this example should not enable a customer to use your time and use your hard work and our combined skill set and knowledge of the market to pass that hard work on to some other individual who's just picked up a phone for them to earn half your commission. It's not right, and that's why I'm really flogging this horse with anyone who will listen.
Sorry. Yeah, so the annoying thing is I had to get the supplier approved with investor.
Exactly.
And I've done that, and other brokers have jumped in it, so they've given the same acceptance to the other brokers, but without personal contact, I don't think they would have approved the supplier.
What's that deal called, Ian? Is it one? It's one we've looked after for you, is it? Yeah.
It's an Indian one.
Okay, I'll have a look at that.
We always have that situation whereby I would get somebody else that could look at the figures and say, okay, it's going to do my next month. Now we're just going to do it at 7 month.
You're right, but until today or yesterday, you could duck. You had no idea whether the price difference, if there was any, was deposit related, term related, product related, HP to lease. Whereas it's just, this extra disclosure document is literally just inviting people to negotiate.
That's at the point they're signing the agreement. Surely at the stage that it's at now, it's not going to accept it. This is the amount of month. Surely we're always in that situation where they can speak to someone.
Yeah, exactly right. But you're exactly right. So in that scenario, the problem there is a dual acceptance, not necessarily a commission disclosure. But there's now another link in the chain. So Ian has now got to get past the commission disclosure as well. So yeah, that's my main takeaway, is we need to understand how these lenders are going to behave. We'll be watching that very closely. We as a network are not adverse to turning off the tap with certain lenders when they don't listen.
I think it's something you mentioned, obviously, competing broker to broker. We also need to mention, I'm not saying it's all lenders is most good, but there's also got to be something because we were direct on that.
Exactly. Exactly, and it happens. We weirdly, like in the last couple of weeks, we've had a customer on Moorgate's side who we write a deal with a lender. Next thing he does is pick up the phone direct and say, "I want to work with you," and cut Moorgate out. He's done that with 4 lenders. Yeah, just the ones you want. Yeah, I've actually met the guy. Yeah, I've actually met the guy, which is probably the problem. He's a horrible customer, but we've got a really good lending panel, so we're able to find the cheapest lender. We were able to get one deal out of him from the cheapest lender first, and then every lender that he's tried it with, which is now I think 4, rings up and says, no, you can't deal with us direct, you've got to come through Moorgate. So whether it's in our T's and C's, and where it can be, it is. But whether it's in our T's and C's or not, we are a big enough fish that these lenders are scared of antagonising us to that effect. And I do take it personally, and we do turn off revenue to these lenders when they misbehave. So we do have those levers to pull. Yeah, it's a good point. I think it's quite important that I keep looking up there because I've got a whiteboard with these, with our stages written on. It's quite important, in my opinion, and I'm very comfortable with this from a compliance perspective, that you are not disclosing the amount of commission you are earning until a set of documents are in a customer's inbox. We legally have to disclose it, and we have... Absolutely, yeah. The funder will come back to us or you via us, and say, are you willing to do the deal for free? And if the answer is yes, then they will absolutely accept business from that. But if we are going to earn any money, that disclosure needs signing. And my guys internally are being told not to negotiate on these fees because I think we can justify them. The good news is, anyone who's been doing this for a while knows that customers are interested in probably three main things when it comes to taking commercial finance. Firstly, is my house in danger? Have I signed a personal guarantee? Secondly, what's the monthly payment? And thirdly, what's the total cost of finance? They will have the answers to all three of those questions before they receive your disclosure document. And if they were happy with the answers to those three questions, and it's just the disclosure document that makes them feel uncomfortable, then you've just got a problematic customer, because he was fundamentally happy with the agreement and the deal that you put in front of him. But that's my takeaway on it. And so we are not declaring our commission amount until the customer has the docs in front of them. Whether they see that commission disclosure or not, they are signing it. Whether they will have to sign it, either by DocuSign or by wet sign. Whether they absorb the information contained within it or not is the first question. Whether they are bothered by the information within it or not, i.e. whether they think it's of value for money, is the next step. And the third step is unless you've got absolutely no relationship, they're not going to now not speak to you. They're going to ring up and moan like blue murder about your fee, and that is when you've got the opportunity to justify your fee using all the bullet points that we went through a minute ago, which will be in your inbox after this call.
Funny enough, as we speak, I've just had a commission disclosure wording sent to me by Siemens Financial Services.
Ah, that one's out. We hadn't had that one yet, so that's a good one. Siemens. Who, sorry?
Sorry, what was that? Sorry, I was saying, Thomas Ford is led out mode as well.
Oh, yes, yeah, always.
Yeah, it says, on activation is finance agreement, SPS will pay us commission directly, then they'll set out, blah, blah, blah. Commission is not an additional charge to you, but it's included in the amount financed under the finance agreement.
Yeah. The other way, and you guys can phrase this how you like, there's no ruling on how we justify our commission. Another one that one of the guys used successfully yesterday, guys signed it, so acknowledged the amount, questioned the amount, signed the disclosure on the back of my account manager saying, that's not money I'm charging you. I'm not asking you to pay any more money. That is money that you agreed to pay me when you accepted my quote, or agreed to absorb as the cost of finance when you accepted my quote last week. That is going to the bank regardless. The fact that I've negotiated a margin of X from the bank has literally no effect on your cost of finance. So it's immaterial. I could have had 100% of that margin or done this for free. Your monthly payment would not have changed.
So if one of us is man enough to say, yeah, we would do the deal for free, the finance documents are still at the same amount to the customer.
Yes. The rate, that by the way is our approach. So the reality is, if you knock £1,000 off right now as it stands, if your customer refused to sign that, and you said, I'm going to wipe off my £1,000 worth of earnings, the total repayment could go down. I.e., we are able to instruct any one of our lending partners to lift their margin to cover up the commission that we are now not taking. No lender, how ironic, is going to object to lifting their margin to sacrifice ours. So we can just move our commission into their pot. There's no benefit to doing so. We can't have some hidden payment in the background or anything like that. But it does allow you to hold to save face with your customer. If it's a deal that's supplier introduced or similar, and you just really want to get the deal over the line, then you've got three options. Say no, concede, but give the lender the margin, so they now sign a letter that says Ian's not earning any money, but the monthly payment's the same, or concede and actually reduce the cost of the deal to them. I am vehemently opposed to option 3, but I don't control most of the guys on this call, so you guys do what you like. Internally, we are not conceding and making a deal cheaper for the customer. Anyone got any questions, problems, concerns at this stage? We have had some very panicked account managers internally. As a management team, as an operations team, as a leadership team here, we're fairly relaxed about the whole thing. This has been kind of coming for a while. B, versus a lot of our competition, I think we add a huge amount of value to our customer base, and we do a good job. There's a bit of a learning curve to be had, but in the last working day, we've had several of these commission disclosures signed. The vast majority have probably not been read, and the ones that have not been challenged.
Slightly on a tangent, but for our earlier conversation, Jacob contributed. Do you have a customer mandate document I can try to do to stop, multiple brokers pitching on the same deal and undercutting the commission?
We absolutely do, yeah. We've got MBN branded ones, like generic ones, and we've got lender specific ones. Just a word of warning, these lenders are fickle. All that it takes is another broker to send them one dated the day after and they win. No, honestly, Ian. Yeah, there's no lender doing mandates on the basis of a time lockout. The exception to that's probably Funding Circle actually, but there's no asset finance providers out there who will do it on the basis of time. The best thing you can do, to play the psychological game. The best thing you can do is pick up the phone to us, and we'll apply pressure to the lender, because after EFT and AFS, we are one of the biggest lenders for the majority of, one of the biggest brokers for the majority of our core panel lenders. So we can push them around. That is literally the point of this collaboration.
Can you sort out to the days where you used to submit a deal and funders used to say, thanks, but we can't consider that because we've already sent it to someone else?
Yeah, that would be nice, wouldn't it?
Is that how it goes?
Well, I actually think it will move back to that. I think it will move back to that. And the irony being of the whole scenario, that if it does move back to that, and there is a fairly niche business in the market that only one lender can do, you now know as a broker that you can charge the consumer through the nose because he's got nowhere else to go, which is the backfiring nature of any kind of massive move like this. Is that, our Investec have paused all consumer lending, sole trader limited company lending. Close have done the same, a lot permanently, or they're saying permanently. We're pulling out of those markets. It's just not worth it. So if you're a consumer now going to finance your asset, your choice is just massively limited. So of course prices are going to go up. Yeah. Absolutely, yeah. And everything is focused around price, but you know as well as I do that I would say less than half of our customers on a monthly basis buy purely on price. They're buying on security, speed, convenience, terms, and everything is now just being decided on pounds and pence of our earnings, not their costs, which is bonkers, but we are where we are.
Okay.
Any other questions? Anyone else got any concerns? The main message from here, guys, is don't panic about it. Back yourself in terms of the value you offer your customer. And I think this is a much bigger thing in our heads than it is in that of your customers.
Okay.
Yeah, give us a call. All right, thank you, everyone. Cheers. Bye.